All right, without further ado, we're going to welcome in part of our trading team, Blue Chip Trader, Event Trader, Chart Trader, and Scalp Trader. And what we're going to do is provide everyone with a backstage pass to one of our strategy sessions. This is where we get together and we talk about what we're expecting from the markets, maybe some potential trades, some themes, all those dynamics, and we can bounce some ideas off each other so you'll get an inside look at some of the things that go on in our trading room, around our trading desk. And with that said, we're going to welcome all you gentlemen in. Good morning.
Happy Valentine's Day.
Good morning. Happy Valentine's Day to everybody.
Well, thank you. Thank you, all you sweeties.
I love you, Jim.
Yeah, now I'm blushing. So anyway, so now that we're past rock star time, we'll bring all you guys in and talk a little bit about the markets and what we're seeing. And typically what we do is we have everyone take center stage and talk about what they're seeing in the markets. Whoever would like to go first, feel free to jump in. Maybe Chart Trader, since you got more of a macro approach. Sure. Would you like to start off?
That's perfectly fine.
All right.
So howdy guys. So what I'm seeing, and I've talked about this lately both in my notes and in my chart book and with Jim and in my posts online, pretty much a continuing theme of there's a big, really interesting and really unusual conundrum that I think really defines the market right now, and it's offering interesting trading setups like the NASDAQ setup we had this morning. But the idea basically is we see a huge technical overboughtness to the market. It's run a long ways over the last 7 weeks in a relatively straight rally with very little in the way of pullbacks. And yet we continue to see data come out, the latest of which was earlier this week in the Bank of America Merrill Lynch Fund Manager Survey, which is a survey of over 200 different fund managers managing over $500 billion, who said that they are the most overweight cash that they have been since early 2009, and that they have the lowest global equity allocation than they've had since September 2016. We also see the HFRX to SPX 3-month trailing beta, which is a way to track how involved hedge funds are, showing hedge funds are not really engaging long this market. And we have a couple of different indicators showing that retail investors haven't really bought into this market to a great extent on this rally. So what we have is a huge shakeout happened in November and December. It cleaned a lot of people out, but there's some folks that held through that process because they believed it was some kind of market freak out, some kind of, algorithms gone wild or something, and that there was no fundamental reason based on economic data to start selling off their assets. So they stayed with the market. And once they've made that decision, I think that this rebound isn't offering them any reason to sell. If their thesis was right in holding through that decline, then there's no reason to start selling now. So there's a bunch of people that are sitting on the sidelines that are skeptical of the market cycle, and there's a bunch of people holding the market that aren't. And there's a huge difference between the two of them in terms of their outlook. So we're seeing the market actually rally on net outflows right now, which just means the main thing forcing the market higher, it's more about who owns the market not selling than it is about who doesn't buying. And that causes an interesting kind of future conundrum as we look forward. You're going to see one of two things play out. Either the people who've been sitting out and refusing to buy in are making sense because they see longer term indications that while there's an aggressive bounce in place, the cycle is rolling over, that we are seeing some forward-looking economic indicators and market indicators, like the flattening yield curve and possible inversion coming up, like all the sovereign debt in the world, the largest total dollar value of sovereign debt around the world trading in negative yield territory, like the strong rally in the dollar, that all suggests that we are seeing a kind of tipping point in the cycle and that the bad economic data is going to start to hit. And, or the people who are holding on are going to end up being right in that the market's going to start to rally because the money on the sidelines has to come in because that turn isn't going to start taking shape. And we've got an easy Fed. We're going to see the end of the trade war. There's no more government shutdown. And we're going to start to see earnings and economic data improve for the rest of the year. And we'll see new all-time highs. So it's this huge kind of binary situation right now. And that's why this morning's retail sales data is so interesting. Because you can look at that as it's a one-off data point. It doesn't make a lot of sense. There may have been some data collection and processing errors because of the government shutdown. It's not necessarily representative. You can find a million ways to try to undermine the value and importance of that data. But it could also be kind of the first red flag in a series of data points that show that we are starting to roll the cycle over, that we are starting to see more risk aversion, not just in markets, but also in the real economy. And I think it's just going to really highlight the importance of the next few big data points, especially forward-looking data points. If we start to see some of the economic surveys start to pull in quite a bit, we're seeing that around the world. If it starts to happen in the U.S., it may throw a little more confirmation on this and may cause some of the people who've been holding through all of this to start to get on the offer a little bit more and start to sell into some of these rallies. But as far as setups on an intraday basis, this morning was a great example of my number one rule, which is when you have bearish sentiment data and you have a big gap down and you have an uptrend, it doesn't matter what you believe about that data that caused the gap down, whatever it is, you buy. That's what you do, you'll make money. When you have bearish sentiment, you've got people who want to short the futures in the morning, you've got money on the sidelines, you've got an uptrend, and you've got a gap down. Just close your eyes and buy. And it offered us a good chance in the NASDAQ. If somebody bought into this latest dip off of the Bloomberg headlines on the trade war, it was another example. If I were to envision what a bearish setup would be over the next 1 to 3 days, I would suggest a squeeze through yesterday's highs, a squeeze up to new highs for this rally, and then a rollover. And then we start to maybe see a confirmation data point that says that retail sales number wasn't a mistake. And then we start to see that what's been kind of holding this market up on little dips is, we've got all this money on the sidelines, and some of that money is coming in on every little dip because they feel a little underexposed. If we start to get some information that confirms that more bearish view about the next, say, 2 quarters, maybe 3 quarters, as far as the macro cycle is concerned, then that bid's going to drop away. And some of those folks that have been holding on through everything maybe want to take a little bit off the table, so we see that kind of a greater traction on a dip. But gap downs in a trend like this with the sentiment data where it is, even if it's going to end up being an inflection in the market, are usually a good intraday buy point. So that's my general thoughts right now.
Chart, I have a question. You highlighted the weakness in you highlighted the weakness in financials today. What is that telling you as far as what's going on in the dynamics and how this data point should be factored in?
Okay, so I mean, if you look at the big banks, their profit margin is essentially the yield curve. I mean, it's a clunky way to look at it, but it's broadly correct. And if we do see data confirming this, you're going to see a further flattening of the yield curve or maybe an inversion of the yield curve. We've had some data points lately that have steepened things just a little bit, and that's forced some money flows back in. People have decided, hey, if I want to hedge for the possibility, maybe they're out. They don't have a lot of exposure to the market, but if they want to hedge for the possibility that they're wrong about the cycle, banks were really washed out in December. Banks are what you buy because you're going to see either that or it's a yield curve trade. I mean, you can make either one, but the banks become kind of a yield curve trade. They make money when the long end of the curve is at higher interest rates than the short end of the curve. If the Fed is on pause and they're not hiking, that anchors the short end of the curve. So when you see positive economic data, you're going to see the long end of the curve rates move up. That means banks are going to be more profitable in their future earnings reports. This morning's data point was a move in the opposite direction. It was saying, hey, maybe the cycle is rolling over. Maybe we're going to flatten that yield curve further. Maybe banks are actually going to get hit harder. They're going to be less profitable. They can make less from each new loan. So it really does kind of, factor into the banks just as much as it did the retailers, I would say.
All right, so is this weakness in the financials right now a big concern for you?
I mean, it's just the same. It's like it's essentially, if that data point was correct, then they're going to take more heat. If we see confirmation that we are moving into a period where we're going to see sudden, surprisingly weak economic data points, and it's not just a one-off thing because people were panicking in December because of the stock market, but it's actually something that's going to be sticky. Let's say retail sales really were down as much as they appear to be. Let's say next month it gets even worse. Let's say retailers start to fire people, et cetera, et cetera, et cetera. So, that's how these processes take hold if you're looking at an inflection in the cycle. It may not be the case, it may be the case, but right now the banks are going to overreact to data points relative to other areas of the market. They're going to overreact to data points that suggest that possibly the people who are sitting out on this rally are going to turn out to be right over the next few months.
All right. We can move on over into, we'll talk to Damon, a.k.a. Scalp Trader. Good morning, Damon.
Hey, Jim. How are you?
I'm doing okay. You've been very active in this market over the last few weeks or so. So what are you seeing in the overall scheme of the markets?
Well, as the chart has noted, we've had a huge run since the December lows, and so I've been sitting back trying to pick off some reversals. Also, we've seen an uptick in intraday volatility based on news events. Stocks that have run, bounced dramatically off their lows, may get a squeeze out to new highs, and then a reversal intraday. Shorts are starting to be a little bit more aggressive. But based on the steady inflows that we continue to see into this market, I'm a little concerned about the two-way action. I don't feel like the two-way action has been quite as strong as I would like to see, and I think I'm going to really start to focus on the swing opportunity in mid and small cap names. I still think that's one really undervalued area of the market, and that even if the market goes sideways here for a while, you'll start to see some opportunity in these smaller names. Over the past week or so, I've probably added 4 or 5 new names, and they're mostly names with market caps under $600 million, and they're all actually doing pretty well. And I think the opportunity to, on a swing basis over a 2 to 6 week period, to make 20 to 60% returns on these types of names, I think we're in that kind of cycle, that period of this market upswing. People are feeling more comfortable that the market is on firmer footing, and you start to get that trickle down effect of money flowing to some of the kinds of secondary plays, the theme plays, and just undervalued names. I think value has really been out of favor for quite a while. So the opportunity for some of that money that's been sitting on the sideline, that's missed the big rally in some of the major names, I think values poses a really attractive opportunity for people who are, really numbers and fundamentals based.
All right. I'm not sure if everyone saw it, because if I recall, your post on Tesla was kind of in the evening hours and whatnot. So since we have you on here, what's your overall thesis? Because I think you were getting a little bearish on Tesla.
Yeah, and I was actually in the process of writing a comment on that I was going to post on the page a little bit later today. I'm definitely bearish on Tesla, and I'm really just trying to figure out if it's worth my time to short the stock. I looked at the puts, and the puts aren't compelling. The prices are still too rich for me. And in terms of shorting the stock, I think that it's one of those time horizons that, it's going to be like a year to 18 to 24 months for it really to play out for 30 to 40%. And when I think about allocation of capital and commitment of capital for a period of that, for that length of time, a 30 to 40% return just isn't all that compelling to me. So I wanted to put the idea out there, just that I'm bearish on Tesla. I think there are a lot of things that are coming up in terms of competition. Audi, Mercedes, Jaguar, a lot of the major luxury brands are introducing models this year and next year. And I think Tesla and Jaguar in particular, they had a comment that's saying that I think 50 to 60% of their recent reservations have been current Tesla owners. So just given the kind of proliferation of Tesla, and just think that a lot of these people lease cars, and they come out of their, going to become rolling off of their lease in the next, after 2 years or 3 years, they're going to be looking for a new electric vehicle, and I think they're going to be moving to other names. And I think that some of the product that's coming down the pipeline is really going to negatively impact demand for Tesla. The other thing is that Tesla has lost its the full tax credit, the $7,500 federal tax credit, because it sold over 200,000 units. And so I think that tax credit got half this year to $3,750, which is one of the reasons Tesla cut their price on their models to reflect the reduction in the tax credit. Eventually that tax credit goes to zero. So essentially when someone goes car shopping, they're going to be looking at Tesla, and it's going to automatically be priced at a $7,500 premium, unless Tesla actually undermines their own margins by being proactive in cutting price.
Speaking of electric cars, you threw a new one on the radar today. I hadn't heard of it before yesterday, actually. Solo. I'm not even going to try to pronounce the name of the company, but you had thrown this on the radar today. Big advance yesterday, like 200%, and it's up some 14% already today. Do you see this as a likely competitor for Tesla?
Not even close.
All right.
Yeah, so I think it got a big run yesterday after Bloomberg put out a headline and did a feature story on it, saying that basically it's a Tesla competitor with a $15,000 car. But what they're producing right now is really just a motorcycle. It's a three-wheeled vehicle, and they do have a couple of vehicles in the pipeline that are actual cars that are going to be priced at a much higher price point. But at this point, these guys have produced only a handful of vehicles. They claim to have over $2 billion in reservations. So I mean, I think just based on as a momentum theme play, kind of a Tesla secondary play, because there aren't a whole lot of publicly traded opportunities there, momentum players will get behind it. I was looking for shares this morning to get a gauge of kind of what the short interest looks like, and I couldn't get a locate, but so I'm looking at IB right now, and they're showing a borrow rate of 57%. So already, I mean, you're clearly seeing high demand for shares of this, and so, you know, from my perspective, for looking at it from a trading perspective, and I look at a name like this as simply as a trading vehicle. I can't say that I'm impressed with the fundamentals, but the market cap is small enough, the float is small enough, and if you get enough short interest built up, that if you get a pullback to maybe that 250, 350 area, you could get a price squeeze that launches this thing to new highs. On a swing basis, one of the things you have to really be careful of is names like this tend to do secondaries. They tend to be pretty opportunistic about issuing secondaries and raising capital. I looked at their numbers, at Solo's numbers last night. They only have less than $20 million on the balance sheet. So they'd be smart to sell stock into this move. So it's not the type of name I'd hold overnight, simply because of kind of the lack of fundamentals, as well as the need for cash that could, a name like this, you put a secondary out there, they could potentially price it 20% below the previous day's closing price or more.
So would you look to buy that if they did do such a thing?
You know, potentially. I mean, if they did it, I'd prefer to see them do it after the stock had pulled back. Even though that creates a lot of dilution, you still get the kind of momentum enthusiasm to buy a stock that's well off the highs, versus a lot of times you'll see companies issue a secondary on a day that the stock is popped big. So if this thing ran at 9 today or tomorrow, it wouldn't surprise me if they hit the market with a secondary that night. You know, they announce that they're going to do a secondary, stock falls to 7, then they end up pricing the secondary at 5, and then the stock trades to 450. I mean, yeah, if I get it at 450 after closing at 10, I'd probably buy some. But a lot of times, just when the stock runs big and you have that secondary offering right afterwards, it creates a major price overhang in the stock. So it's hard to kind of predict what's going to happen here, but one definitely to keep on the radar, simply because of the small float, the Tesla association, and the fact that there's already some controversy associated with this name. So I'd expect shorts to start attacking it into, you know, on upticks.
All right, and another name I want to ask you about right now is here, HEAR, Turtle Beach. This one just spiked. It's up 10% now. I'm not sure if there was any news or anything, or just a short squeeze, but I know you follow this one pretty closely.
Yeah, so I mean, that's an example of the small and mid cap kind of swing opportunity that I was really just talking about. I mean, this is a name we bought, I think, 2 days ago, around 16 or so, and it's ripping 12%, 11% today, approaching 19. Really cheap market cap. The new game that Electronic Arts just released is bringing enthusiasm back to the space, and there are a lot of shorts in this name. Small market cap, extremely high short interest, and now you have new buzz associated with the name. So that's the type of setup I like. Value, high short interest, small float. I mean, that's the type of name that can give you a 40% return pretty quickly. And I think we're in that type of environment where I'm definitely going to continue to focus my resources on these types of opportunities.
And you're already long this name, right?
Yeah, so we got long, I think it was Tuesday, either Monday morning or Tuesday morning, at, I think it was 16 or so. Let me see here. I bought it on the 3rd. Let's see.
Trend was on the air last week also, saying
yeah.
that he liked it a lot.
Yeah, I bought it on the 12th, so 2 days ago at 16.10.
Yeah, and Trend, he was going to join us, but he's going to be on tomorrow. He had some things he needed to do. Otherwise, we'd get his color on it today, but we'll have to wait for what he has to say tomorrow. But I'm sure he's liking the move here today in HEAR, already up, well, 9% now. All right, Event Trader, let's bring you in and what you're seeing in the markets.
Yeah, I mean, basically what I'm just keeping an eye out on is, I've been talking about it for a while, where I'm just expecting some choppy conditions for the most part until we get a little bit better idea of where some of these big tail risks are going to go. We're pretty much at fair value at this 2750 level that has us at about 16 times forward PE. And just kind of to build off what Brett was saying with that global fund manager survey, I was curious to see where fund managers were looking for in terms of the biggest tail risk. And probably no surprise, trade war was the top one at getting 29% of the votes, and that was actually up from January. So that tail risk, and then this was a survey from February 1st to the 7th, has increased. The second one is China slowdown, and then they kind of break into the corporate credit crunch, U.S. politics, quantitative tightening, and other, and then you hit Brexit. And I was kind of really surprised to see Europe not a bigger concern for some of these market participants. So, you know, just kind of looking to see some of these headlines clear out, because I don't think that we could really find any big buyers above these levels until we pass through, until we get some of these issues passed. Now, to the downside, to the other side, to the support side on things, is, as Brett was saying, just the amount of money that's sitting on the sidelines in cash. And with that, I just think that we really have an area where we're going to find a pretty choppy environment for the next couple of months until we get a lean one way or the other into a positive reconciliation for some of these tail risks, or a negative. The other item that is really piquing my interest is, I know we're still just getting to the tail end of Q4, but Q1 earnings season, where we are looking at, you're going to start seeing a lot of commentary about earnings recessions, which right now we are looking at basically a flat year-over-year earnings growth coming up for Q1. Now, a lot of that has to do with some pretty tough comparisons, because of course Q1 is when that corporate tax cut went into place. So you're going up against a tougher compare there. But if we have a weak Q1 earnings season, and we're going to start slowly getting more sell-side shop commentary coming in, and a little bit more color on how Q1's rounding out, and that's going to really play into the market psyche here. So these are some of the bigger issues that I'm looking at coming up. Now, in the meantime, the actions that I'm looking to take is basically finding good, strong names with high dividend yields, such as the XOM that I added, or good, strong names in good spaces, in the cloud software being an area that I'm particularly looking at, such as a Salesforce.com. And for, you know, my bigger investment portfolio to kind of lay out in these areas. And then, as Damon was saying, keeping an eye on these smaller and mid-sized companies for more shorter-term swing positions. I feel like this is going to be a real stock pickers market over the next 2 quarters. I think you're going to see the winners in earnings really rewarded, and the losers kind of get beat up. We've seen that play out a lot in the earnings reactions to some of these names. So one of the things that I'm going to be doing over the next 2 weeks is circling back to some of these earnings and kind of grabbing the ones that stuck out that had a particularly strong or weak report and taking a look at those charts and trying to find good swing ideas that it might seem like a name's going aggressively too high or aggressively too long, but I do get the feeling that we could see in a stock picker's environment with the winners getting rewarded and the losers getting beat up, overextensions in some of these names. So, that's kind of my philosophy for the next couple of weeks, and just kind of attacking through there. So that's some of the things that I'm seeing in the markets. But the grander market, the macro side of things, I really just see a chop in going across for the NASDAQ, S&P, until some of these issues maybe not find closure, but find something that the market could really kind of calculate into their equations. But overall, that Q1 earnings season is just going to really stand large, and I'm curious to see how the markets would react to any sort of hint at an earnings recession in the U.S. here.
You know what's interesting? The earnings season that we're having right now kind of blends into Q1's earnings season, so it'll almost feel like we're going to get a pretty quick update on what's going on around, because it's essentially, we're almost at the end of, well, mid-February now, but it seems like we're going to get another update in the not too distant future as far as earnings go. So
well, now we did get NTAP this morning, which was a January quarter end date. Mm-hmm. Had a little bit lighter results. So and we're going to start getting the Microns and the FedExes in a couple of weeks out here. Obviously, the main isn't coming into April, so we will start slowly getting some more information on Q1 in the next few weeks.
And I suspect we'll have the retailers out in the next week or two too. So we'll probably get another. That'll be another input that we can use for Q1 as well.
Yeah, exactly. And I got a quick question for Brett on the fund managers survey. Brett, I'm curious as to your take on this.
Sure.
The two most crowded trades, long emerging markets and long U.S. dollar. Doesn't that seem kind of like a juxtaposition for you? Like, I mean, it seems like a stronger U.S. dollar should lead to weakness in emerging markets. Do you find that interesting?
I find it interesting. I find it interesting, but I can rationalize it in my mind. It may be that these are two markets that are surging lately, and maybe people don't think that they should be, given a lot of factors. And so I think that question really asks people, what do you think are the two, or what do you think is the most crowded trade? That doesn't necessarily ask people, what have you crowded into? You know what I mean? So it's not a genuine reflection of exposure. It's a reflection of what people think too many other people are in. So it's a little different than saying that those two are the most crowded trades. It's that fund managers believe that those two are the most crowded trades. In fact, it might be that fund managers in this survey are the least likely to be exposed to those trades because they think that they're crowded. So it's a little tricky in interpreting that question every time the survey comes around. There's always that point. We had the same issue with Bitcoin when it was at 10,000 and 12,000. It wasn't necessarily a reflection that people thought that they were, that people were in Bitcoin. It was that they thought Bitcoin should go down, and so they thought it was too crowded. But at the same time, it kind of reflects a sense of people believing that the disparity between the U.S. and the rest of the world should converge some. So there's that aspect of emerging markets. And then at the same time, historically, the dollar tends to rally when the Fed first starts to get dovish in every cycle. And that's another reason why I brought this up earlier. It's an important realization. Generally speaking, if the Fed has topped the cycle, then usually the dollar starts to rally through the Fed's initial turn toward dovishness, which may have just happened, depending on how things play out. It may be that the next move is a Fed cut, in December or something, and in which case the dollar would tend to rally against that, despite the fact that, it's the Fed turning dovish, usually because when the United States starts to turn in the cycle, money generally flies into the United States for protection, because the rest of the world usually does worse, at least initially. So I think there are two different themes that are happening. One is a convergence trade, and the other is a cycle bear trade. And I think that it's not necessarily straightforward in terms of saying that these are the most crowded trades. So that's how I would respond to that.
All right, no, good stuff. Hey, I got a quick question for Damon too, or do we want to get Scott in here first?
No, go ahead and go ahead. I'll bring Scott in.
Damon, just a quick question for you, because you know, I was talking about the yield plays, and you always do a great job with your yield portfolio. What is your process? You know, not looking for picks, but what's your process for looking at these yields? Obviously, that NGL that you were talking about, that was a pretty sexy looking stock there, and it's making a nice move. What are some of the processes that you look at when you're looking for your yield portfolio?
Well, I have two components to the yield portfolio, kind of like the speculative, more capital appreciation focused approach, which NGL would fall into, versus the more steady, consistent income generation approach, which would be most of the preferreds that I own. And so with NGL in particular, as I noted, it's a name that I've been following for 2 or 3 years. I mean, at one point, I think the yield on this thing was probably 25%. When the business wasn't going so well, I think they may have had to cut their distribution at one point, and made a lot of promises that weren't met. Over the past couple of quarters, their business has really started to fall in line. They've exceeded expectations. They've dramatically reduced their debt. They've sold businesses, monetized businesses to generate cash at multiples that were much higher than the market was awarding them. And so at this point, they're sitting with a lot of cash on the balance sheet. Debt is much lower. Income is rising. They're in a position where they can actually start to raise their distribution, but instead they're going to actually buy back stock instead. So it's a situation where, I mean, I probably have 30 high yield type of names that I'm following right now, and so it's all about timing, understanding, because you know, some of these companies will go out of business, some of them will be phoenixes. I mean, they'll rise from the ashes. And so today I put on a position in CBL, which is a distressed mall retailer, and it's a really interesting story. I mean, they've had to cut their distribution. The yield's around 12-13% right now. They're generating about $200 to $250 million in excess cash flow at this point that they're using to remodel their stores. And so they have a lot of, say, Sears stores that are being closed, and they've done a really good job of bringing in new tenants. So, for example, they just announced last week, or actually this week, that one of their shopping centers, they're putting a new high-end hotel there. And so that's a way, kind of the mixed-use approach that they're doing with malls now, where it's not just retail. I mean, they'll put a Whole Foods in, or a Dave & Buster's, or you know, just any variety of different types of uses. And so if they get this right, I mean, this is one of those stocks that could be a 4 or 5 bagger over time. Of course, it could also, you know, if we have kind of a downturn in the economy, retail sales start to slow more, you get more retail bankruptcies, the cost of debt, refinancing goes higher, then this is a company that probably will end up in bankruptcy. But at this price and at this point in the cycle and just kind of the convergence of events, I think it makes for a really interesting opportunity that you could look up 2 years from now and find that the stock is 4 times higher.
Hey Damon, since we have you on the line, I have a listener question for you, and it goes back to HEAR, and he's talking about the shift in your tone on this one. And he states that a couple of weeks ago there were talks about the biggest shareholder unloading shares at lower highs, and that wasn't something that you viewed as a sign of confidence. Does this not concern you as much as it did? And so what's your overall takeaway now?
Well, at that point, there's really just no catalyst, right? The only catalyst were the company's earnings. And so they have a history of pre-announcing to the upside, the stock gaps up and then gets knocked back down, and the actual earnings report is really a non-event. So shorts have kind of learned that when HEAR pre-announces, you short the uptick, you make money. And and with the the large holder consistently selling stock into each uptick, I just didn't feel like there was anything around to really break the stock out, because every time it ticked higher, this holder comes in and unloads shares and kind of puts a cap on the price action. But last week, Electronic Arts released this Apex Legends game, and the numbers are through the roof. I mean, that's all everyone's talking about. So you have a new catalyst. I mean, basically, people are betting that this is the new Fortnite, or not even just that, but that major game makers can actually produce these battle royale multiplayer games and have them be hits. So, which continues to drive this market for headsets, and you're actually getting to the point where, you know, one of my concerns with here was the replacement cycle, right? Like, you buy a headset, how often do you need to replace it? Well, you know, if this is the new thing and people are going to be playing these games from now on, at some point you will need to replace them. So, I mean, so there is an actual replacement cycle that could come into play the longer you have this momentum behind this type of game. And so I think with the Apex Legends, just like you saw with the with Fortnite, momentum players will be focused on this opportunity now. And so whereas here it kind of fell to be a momentum, had lost its momentum and his enthusiasm amongst the momentum players over the past couple of quarters, I think that's coming back now. The market cap is it's a really attractive valuation. So even if this thing doubled, it would still be relatively cheap. And so when you get a momentum name that is trading at cheap valuations, I mean, a double isn't out of the question.
I think you want to root for these games getting tougher and tougher, and that'll help the replacement cycle. Kids just throwing their headset down, and then you got to go buy a new one. That's your catalyst to get replacement cycle going.
Yeah, maybe. And I think part of the replacement cycle too is that as kids get more engaged in these games, you know, when they're convinced their parents to go buy them a $20 headset to start off, and now they're realizing they're at a disadvantage, you know, for their birthday or for Christmas, now they want the $80 headset or the $130 headset. I'm already seeing it at my house.
Yeah, it's very interesting to say the least. All right, Blue Chip Trader. Now, I know you don't necessarily focus on the macro to formulate your strategies and whatnot, but one thing that is for sure, and it's a difference between you and Chart Trader, is that when the VIX goes down and we drift below the 20 threshold, here we are trading in the $15, $16 threshold, you kind of step up your game a little bit. And I suspect that that is part of what's going to play into your overall strategy going forward.
Yeah, of course. We've mentioned this before, that the beauty of our service is that we each have our strengths and our weaknesses at different cycles in the market. And when the market was correcting throughout Q4, you saw the VIX spiking considerably. I take the portfolio manager approach, or the institutional approach, which basically says lighten up on everything and be focused on, get tighter risk management constraints. In other words, you know, reduce position sizes, start hedging more, and trading in less, and just kind of keeping everything very light and simple until the dust settles. Whereas somebody like Chart, you know, he's going to thrive on that increase in volatility along with scalp, and you know, just take advantage of the intraday swings. You know, when the Dow is swinging 100 points, sometimes even 200-300 points on an intraday basis, that's really where you're going to see him step up to the plate there for those types of trades and futures and whatnot. For me, I'm more in the swing trading wheelhouse. So ideally, by the time that, you know, the aggressive drop is happening, ideally I'm out of most of my swing long positions or my growth names that I've been following, particularly from the liquid momentum focus list. And hopefully I also have a couple hedges on. And that was the case during Q4. Q4, I think small caps, as we said before, being the leading asset class that we tend to track. Small caps tipped their hands back in October, lagging the broader market, the larger caps, when they've all made new fresh all-time highs. Small caps did not confirm that, and were the first ones to break down below weekly support levels and trend lines. So we got short that as a hedge, and that paid off in spades for the next 2-3 months. But yeah, for sure, now that the VIX is subsided, come back below that 20 threshold, this is where I tend to step up a little bit more, because this is the rebuilding phase of the market. And just to reiterate what happened there in Q4, there was a point in December, and I remember talking to Scalp and Gavin. I look at a lot of internal readings and sentiment readings, and the oversold conditions that we had in mid-December they were at levels that I hadn't seen. Well, I should say they were at levels that I associated with the bottom of bear market cycles. And I'm talking the bottom of 2008, 2009, bottom of 2002, 2003. They were just, everything was just culminating into this extreme bearishness throughout December. And we were only 20% off the highs in the S&P, and it was one quarter. And it was just, granted, there was just all this worry that was going out there, and it started to snowball into different sectors and whatnot. But the extreme levels of people just heading out for the exits in December was just out of control. And I turned extremely bullish once we started getting that Santa Claus rally into year end. And I think that's basically what we're seeing here throughout January and February. As Brett mentioned, there's still a bunch of fund managers and retail investors who are so spooked from the correction that happened last quarter. We're just not seeing anybody really kind of stepping up and buying. And that's so typical. If you do any sort of history and study of markets, the rallies always are filled with doubt. And they're filled, and stocks tend to lift on lesser volume, and everyone starts coming out saying, well, the market's going higher, but the volume's dropping off, so there's not a lot of buyers. Yeah, that's because there's so much doubt. People have been burned, and it's not until price action starts to exceed a certain threshold to the upside that this fear of missing out is there, and you start to see money come back, cash come back in off the sidelines and start being put to work. And I think that's already well underway here. We've had I always tend to focus on a lot of sector strength and sector leaders, and everyone's pretty much heard me before saying that the software space is probably one of the strongest spaces out there in this market the last couple of weeks. Tons and tons of names, from Salesforce to ServiceNow to the Trade Desk, to Autodesk, Adobe, Twilio has been on fire. There's just so many software-related names here that are just lifting the market higher. Which is another interesting point too, is that every time there's a corrective move, when you rally out of it, there's usually new leaders that come about. And whereas the FANG names were all the talk the last 2 years or so, you're not really seeing Facebook, Google, Apple, Amazon. They're not really pacing the way to the upside. I mean, they're trading higher with the broader market, but a lot of them are still trading below their 200-day moving averages. Well, they're just starting to make the effort to recover back above it. They're not really the FANG names are no longer those leading names. Granted, they have the large market caps, but the real leaders are actually hidden in the sub-industries. And right now, I think a lot of it is going to be in the software space. We have aerospace and defense acting fantastic. We have REITs acting great. We have solar stocks, believe it or not. The TAN, the solar ETF, is actually making a fresh February high here. So that's one of the other cycles that I'm watching there. Gold miners have been pretty strong, and gold in general, but I'm always a little bit hesitant. I'm not really a gold bug, but still nonetheless acting really strong. Cybersecurity software names have been doing fantastic. I think it was CYBR had a great earnings report, gapped up, trading above 100 now. You're just seeing a lot of positive responses there. Home construction is another space that I've been looking at. I got long this into year end based upon the lack of downside that it was showing in December. It really had actually held up better than most markets, showing relative strength there during Q4. And that's paying off in spades here. What held up pretty well at the end of Q4 is now leading to the upside. And those are just a few of the underlying sectors and tones that I'm following here in the market. Another thing that no one's really talking about too, I know everyone's always focused, a lot of people are top-down approach, meaning they focus on the major indices. And as I said, I look at the underlying internals. Specifically, I look at the advanced decline line, and the cumulative advanced decline line for the New York Stock Exchange is actually above the October high. And that wouldn't, let me just rephrase that. The major indices, which are all price weighted and market cap weighted, it is, though everyone's still struggling and very cautious because we're coming into the December highs and into the November highs and into the 200-day moving averages. But the New York Stock Exchange advanced decline line on a cumulative basis has already surpassed its October peak from where this market began its correction. So this is stealth. I'm going to call it a stealth bull market that has been underway so far the last couple of weeks. And as Brett said, there's a lot of cash that's just not committed to this yet. And I got a feeling that as earnings season starts to wind down here into the latter half of February, going into March, we might pullbacks. We're going to be due for some pullback at some point. You know, that's probably going to last more than a day or two. But overall, the bigger picture, I am extremely bullish on this market. I think we're going to be just trending right higher, probably up until let's go till May. Let's go up till May and then sell in May and go away. You know, it's a mouthful, so sorry.
Yeah, and then you closed off with a cliche. Look at you. All right, so does anybody have questions that they want to bounce off one of the traders, any clarity or anything else before I dive into a couple of listener questions? Well, I'll take the silence.
Yeah, I got mine out. So.
Okay, all right, well, I actually have a question, a couple of them, regarding Canada Goose, so I'm going to direct it to Scalp Trader, and anybody else can elaborate on it if they would like. So, Scalp, you got involved in Canada Goose, GOOS, a little earlier today, and this has dropped down quite a bit. Let's see, we're trading at the $53 level, so we sank a little bit below the 200-day moving average, catching up with the 100 EMA right now, trading 53. Are you thinking about potentially going back in it?
I am not. So I was looking for just that initial short squeeze off the lows. Actually, Canada Goose is a name that I was thinking about shorting in pre-market. I almost pulled the trigger on a short, but I was going to wait until the market opened to get a little bit more liquidity. And then the thing just dove, and I missed the opportunity for the short. But I was thinking that my rationale behind the potential short was that this would be peak earnings for the company, just coming off of the holiday season. A lot of shorts would be attacking it, and just thinking that it's downhill from here. And so, just given the earnings report, the idea of kind of the top in earnings growth, I thought that shorts would attack this thing. And when I missed the opportunity on the short side, I was basically looking to play the bounce play a squeeze bounce off the early lows, and it was moving too fast. I got stopped out of the first position, made some money on the second position, and I think now I probably want to see this in the 46 to 47 area before getting interested in possibly putting back on a swing long.
All right. Anybody else interested in this name? I find it somewhat compelling now that it's trading down here in the 200-day moving average. But when I see a big move like this, I do tend to wait at least a day or two to see how things shake up on this name. But anybody else interested? Because it has been a hot one that has been traded throughout the trading desk quite a bit over the last year or two.
Yeah, I'll jump in. There's this blue chip. So obviously I wouldn't be looking at this from a swing perspective based upon the aggressiveness of the trend that's in play here. But if anybody's looking for day trading, you always want to focus on higher time frames. Don't get so caught up on the intraday action. So obviously, if you're looking for anything in this position, you're going to want to try to fade the any sort of rally that's in context of the intraday downtrend, which basically puts that in play still around mid 53s or so. So it's basically has that short side bias right now. But if you're looking at a higher time frame, like a 60-minute time frame, it does have this potential support coming into play here at the $52 area. So if you're really looking for a contrarian type of bounce in this name this afternoon, I'd say keep 52 on the radar. If it cannot hold 52, then you're definitely looking at the psychological $50 mark. You want to get down to that level, maybe probe it for a quick quarter or two, and then maybe you get that reversal then. But then otherwise, I'd say you go down just where Scalp was saying. He's looking at it down near the $46 area. So it's 50, 52, 50, and 46. So those three levels that I would watch if you're looking to play the bounce.
All right, before we wrap things up, are there any parting shots or anything we left unsettled as far as what the message that needs to get out there from anybody out?
Nothing I can think of. I just noticed that, I just see a lot of bearishness going on, and even some people on feedback are just, they're wondering why the market's not selling off, Again, the market's not going to do what you think it should do. And it's definitely, if the headlines are bearish and the market's not selling off because we're in context of the uptrend, you got to take that into consideration. Just like Brett said earlier, we've been in a strong multi-week uptrend, and guess what? We've been climbing a wall of worry, and I guess that's what you can call Q4. There was all these worries about government shutdown and tariffs, and you could just throw everything out there in Q4. There was so much concern and worry going into the holidays. And we have been climbing that wall of worry the whole time. So as Brett stated earlier, you get a negative headline that takes some futures down a little bit. Yeah, it's a buy the dip opportunity here. And until that no longer works, your bearish thesis is not going to really hold water. So I would just say, just focus on making money and stop trying to impose your will on the market of what you think it should do. So.
Let me add to that, Scott, because taking it one step further, if you put all those pieces together, then look at the rally that we're seeing intraday right now. You got to kind of use your market imagination and understand there's an awful lot of traders that are fading this all the way up. And at some point, you're going to see that shift into a more directional squeeze. Now, maybe that will form some kind of intermediate top. Who knows? Maybe that's going to lead to a high when it blows through yesterday's highs and really blows everybody out of that short fade. And that might be an interesting opportunity to short into the weekend. I don't know. But right now, this just feels like the type of market where people are just looking at this rally as like, hey, the market shouldn't be going up, so I'm going to add to my short, add to my short. And at some point, it's going to turn the corner and really just roast everybody doing that.
Yeah, I agree 100%. Yeah. And again, look at that headline that came out earlier with the stating that China and U.S. the tariff agreements aren't going, as well as everyone thinks, or whatever it was, and
that
the market took
apart.
And then all of a sudden the market took a hit, and then it turned right around. It completely blew it off. Again, we just got a wall of worry.
We just got a bunch of negative Brexit headlines, and all they've done is stall this.
Again, this is my kind of, I love this type of market because we're in a strong uptrend. We have negative headlines that are just presenting the pullbacks and the opportunity to buy on dips and to take these markets higher. It catches everybody who is bearish and reading headlines and thinking that they can just follow. I guess over all my years of experience, you can't. I'm a firm believer that the headlines and the news are already discounted into the price action. So a lot of times you have to read between the lines in the headlines. You can't just take them for what it is, unless it's a complete, utter shock that nobody saw coming. Most of the stuff. There's a lot of smart people out there on Wall Street, and a lot of big money. When they put their money behind something, they're not going to be so quick to turn. These little blips and noises and other headlines and everything else are just, they're there to shake people out of their positions in context of trend. So. That's my advice if you need it, my 2 cents.
Well, for sure. That's why we do these roundtable discussions, and I'm sure that you enlightened the listeners to some aspects. Especially, you can tell from the tone of your voice that you're bullish on this. I know you said it, but you can tell with the conviction, and that's why we thought it would be a good idea to let everyone hear what goes on when we do have these discussions and our market strategies and how we put all the pieces together to formulate, the trades that we're going to come up with on a daily basis, a weekly basis, and give you some foresight as to what you can expect going forward. Alright, gentlemen. Well, I think we've covered a lot of ground here, and I can't thank you enough for giving us all that insight, and hopefully the listeners out there got some ideas, some education, and we'll be on the lookout for any new trades from all of you.
Alright, thanks a lot, Jim.
Absolutely.
Thanks, Jim.
Thanks, Jim.
Well, you are all welcome, and I appreciate all the listener questions that we got. If you have any additional follow-ups, they're all still here. They'll answer your questions. I will encourage you, though, to leave your email so that if we don't read it on the air, you have a higher probability of getting a response. In fact, if you don't leave an email, there's probably zero probability of getting a response back because we don't know where to send it to. So please, when you do send in a question, leave your email and we can direct it to the trader that you have focused on, or if it's a name that is just kind of generalized, we can at least suspect where the best direction it may go. So with that said, we'll wrap this one up and put a bow on it, and we will have this one archived, so if you missed anything, be on the lookout for that later on this afternoon.